Imagine earning $1 million from the stock market at the tender age of 30. Sounds surreal, doesn't it? Yet that is precisely what Jesse Livermore achieved. Known as one of the greatest traders in history, Livermore's journey from humble beginnings to Wall Street legend is nothing short of inspirational. His book, How to Trade in Stocks, encapsulates his trading wisdom, strategies, and experiences that helped him amass his fortune. Today, we'll dive into the wisdom of this extraordinary trader and learn from his experiences. First off, let's understand when a stock truly becomes a golden goose, worthy of your investment. Imagine you're a doctor, your patient, the company behind the stock you're considering, and just like a doctor, you need to check its vital signs before making a decision. These vital signs are the company's financial health, growth prospects, market position, and industry trends. First, let's talk about the company's financial health. You wouldn't invest in a person with a constant cough and a high fever, would you? Similarly, you shouldn't invest in a company that's financially unwell. Look for a strong balance sheet with more assets than liabilities, steady cash flow, and consistent profitability. You want a company that's making money, not losing it. Next, consider the company's growth prospects. Just as you'd prefer to befriend an ambitious go-getter over a couch potato, you'd want to invest in a company that's growing, not stagnating. Look at the company's past performance and future plans. Are they innovating, expanding? If the answer is yes, that's a good sign. Then look at the company's position in the market. Is it a leader or a follower? A company that's a market leader tends to have a competitive advantage, which can result in higher profits and a more attractive stock. But don't discount the underdogs too quickly. Sometimes, a company with a unique product or service can disrupt an entire industry. Lastly, consider industry trends. Is the company in a growing industry or a shrinking one? You wouldn't want to board a sinking ship, right? So, avoid industries that are on the decline. Instead, look for industries that are on the rise, or better yet, ones that are expected to grow in the future. Remember, a company's stock is like a slice of its future earnings. If you believe in the company's future, you might consider investing in its stock, but be sure to do your homework first. Read the company's annual report, follow its news, and keep an eye on its performance. Investing in a stock is not just about the price, but understanding the company's overall health and potential. And just like a doctor, your job is to diagnose the health of a company before making an investment decision. So keep these indicators in mind the next time you're considering a stock. After all, your financial health depends on it. Now, on to Livermore's market analysis method, a strategy that turned him into a millionaire. Livermore was a strong believer in the power of market trends. He understood that these trends were not random, but driven by a complex mix of economic factors, investor psychology, and global events. His method was not merely about identifying these trends, but also about understanding their underlying causes. He believed that by doing so, he could predict future market movements with a high degree of accuracy. Now let's talk about timing. For Livermore, timing was everything. He argued that even the best stock bought at the wrong time could result in a loss. Timing the market, he believed, was not about luck, but about careful observation and analysis. He would watch the market, observe the trends, and then make his move at precisely the right moment. It was this attention to timing that allowed him to make his fortune. But Livermore's method was not just about trends and timing. It was also about understanding the psychology of the market. He knew that the market was influenced by the emotions of its participants, their fear, their greed, their hope, their despair. He understood that these emotions could drive market movements in ways that were often irrational and unpredictable. By understanding this market psychology, he was able to anticipate these movements and profit from them. So what can we learn from Livermore's market analysis method? First, that understanding market trends is vital. Second, that timing is crucial. And third, that understanding the psychology of the market can give us a significant advantage. But perhaps the most important lesson from Livermore's method is this: that success in the market is not about luck, but about careful analysis and understanding. It's about being patient, being observant, and being ready to seize the opportunity when it arises. Remember, the market is a battlefield, and Livermore's method is a powerful weapon. Livermore had a set of trading rules, his secret sauce to success in the stock market. $1 million at the age of 30, a feat accomplished by Jesse Livermore, was not a stroke of luck. It was the result of a set of trading rules he strictly adhered to, rules that we'll be diving into right now. The first rule Livermore always followed was to buy rising stocks and sell falling ones. It sounds simple, right? But it's a rule that many traders find difficult to follow. It's human nature to want to buy low and sell high. But Livermore understood that the market is not about what we think should happen. It's about what's happening. A stock that's rising is likely to keep rising, and a stock that's falling may continue to fall. By buying rising stocks and selling falling ones, Livermore made sure he was always swimming with the tide, not against it. The second rule Livermore lived by was the importance of patience. He knew that the stock market was not a race, it was a marathon. It's not about making quick decisions and hoping for the best. It's about waiting for the right moment, the right price, the right opportunity. Livermore once said, "The big money is not in the individual fluctuations, but in the main movements." In other words, the real profits come from riding the major trends, not from trying to profit from every little up and down in the market. Lastly, Livermore emphasized the need to understand one's own risk tolerance. He knew that the market was unpredictable and that losses were a part of the game, but he also knew that he could control how much he was willing to risk. He never risked more than he was comfortable losing. This way, he was able to stay in the game even when things didn't go his way. Livermore's rules may seem simple on the surface, but they require discipline, patience, and self-awareness. They require us to go against our instincts, to buy when everyone else is selling, to wait when everyone else is rushing in, to accept losses as a part of the process. But that's what made Livermore successful. He didn't just follow the crowd, he followed his rules. So whether you're a seasoned trader or just starting out, consider these rules. They might not make you a millionaire overnight, but they will help you navigate the unpredictable waters of the stock market with greater confidence and success. Livermore's rules are not just about trading, but are life lessons in patience, understanding, and risk management. These principles can guide us not only in our trading pursuits, but also in the broader scope of our lives. It's about making informed decisions, waiting for the right moment, and knowing how much we're willing to risk. It's about understanding the market, and more importantly, understanding ourselves. Trading can be risky business, and Livermore knew this all too well. He knew that the world of trading is full of pitfalls and traps for the unwary. That's why he always emphasized the importance of precautions. The first precaution is to avoid falling into the trap of groupthink. It's easy to get swept along by the crowd, to buy when everyone else is buying and sell when everyone else is selling. But Livermore warned against this. He believed that the crowd is often wrong, and that a savvy trader must think independently. Another crucial precaution is understanding the inherent risks of trading. Every trade, no matter how well researched or carefully planned, carries some degree of risk. It's essential to be aware of this risk and to manage it effectively. This might mean setting stop-loss orders to limit potential losses, diversifying your portfolio to spread the risk, or only investing money that you can afford to lose. Livermore also cautioned against trading based on emotions. It's easy to let fear or greed guide your decisions, but this can often lead to poor results. Instead, Livermore advocated for a rational, calculated approach to trading. So remember, when you're stepping into the trading arena, don't follow the crowd, understand the risks, and never let your emotions dictate your actions. Trading is not a game of chance, but a game of skill and understanding. Now let's summarize everything we learned from Jesse Livermore's How to Trade in Stocks. We've discovered the secrets behind assessing a stock's worth, understanding that it's not just about numbers, but also about the company's potential and the broader market context. We've delved into the Livermore market analysis method, a unique approach that combines technical and fundamental analysis to make informed investment decisions. We've explored Livermore's trading rules, which emphasize the importance of patience, discipline, and a clear strategy. And finally, we've highlighted the critical precautions to take when trading, keeping emotions in check, not over-trading, and always having a plan for both profit and loss. These are not just tips, but guiding principles that can lead you to success in the challenging world of stock trading. And that concludes our journey through Livermore's wisdom. Remember, the stock market is not a casino, but a platform for the wise and patient. Invest wisely, and you too could become a millionaire trader.